I've been investing in real estate for almost 12 years now. And for pretty much the entire time I've been doing it, I've invested in Colorado. That's because it was easy and it was what I knew and it was a great place to invest. But 2 years ago, I moved to Europe. I now live in Amsterdam, and that forced me to think about investing a little bit differently. All of a sudden, rather than just investing where it's convenient for me, the entire United States opened up to me as a potential place to invest in real estate. And although I've only been investing currently in syndications, I am currently looking to buy single family and multifamily properties in a couple of different markets across the United States. And the only way that I've been able to do this and start to feel comfortable investing in these new markets is by narrowing down the number of metrics and criteria that I use to pick a new market. Because at the end of the day, there are so many different things that you could be looking into, and you have to focus on what really matters. So today, what I'm gonna do is share with you my 7 top metrics that I look at when I am evaluating an out-of-state market. And hopefully this will help you, like it has helped me, identify great places to invest. What's going on, everyone? This is Dave Meyer. I am so excited to be here talking with you today about out-of-state markets because this is something I am currently working on right now. Like I said, I've been investing with some syndications out of state, but I am really excited to start jumping in and actually buying homes that I'm going to own solely in these different markets. And I've been doing a lot of work and figuring out what metrics are the most important, and I'm excited to share them with you today. Just 2 notes, because we do have 2 important things for you today. 1, we will link to this PowerPoint if you want to download it. And 2, if you are going to invest in out of state, one of the best tips I can give you, other than these 7 metrics, is to use the BiggerPockets Agent Finder. It's completely free. You can find it at biggerpockets.com/agents, and it's really the only place on the internet where you can find a directory of investor-friendly agents. I am talking to 3 or 4 of them right now, and they've all been excellent. So as you think about finding new markets to invest, make sure to check out the Agent Finder. All right, with that, let's get into the 7 metrics that I look at when evaluating an out-of-state market. And I'm going to pull up my handy PowerPoint here and walk you through a deck. So why out of state right now? Well, for me, it's mostly that there are a lot of opportunities all over the country right now. Denver doesn't offer the greatest cash flow, but still offers great appreciation prospects, in my opinion. But I want to create a balanced portfolio. And to me, that means I need to look outside of Denver to make sure that my portfolio not only has assets that are likely to appreciate, but also have assets that are going to deliver great cash flow for me as well. In reality, I have to look outside of Denver and Colorado. So I am casting a super broad net and looking at the entire United States. And in addition to, even if you're a new investor and just looking for a market to invest, if you're an experienced investor, I really think that investing in multiple markets allows you to improve your options. There are certain markets I look at, for example, that don't have a lot of duplexes. They're only single families, while others have a great housing supply of quadplexes. It really allows you to diversify your strategy. And as the saying goes, with most investments, if you diversify, it limits your risk. So those are just some reasons why I'm thinking about investing out of state right now. But ultimately, it really all comes down to your strategy. And I say this all the time, whether on the podcast or on this YouTube show, but it's really up to you. If you are about to retire, you're probably going to prioritize cash flow more than appreciation. For me, over the last 10 years, I've really favored appreciation, and now I'm trying to build a more balanced portfolio. But really, it's up to you. So the first step in investing out of state and figuring out where you want to invest is thinking about what is most important to you. Do you care about cash flow? Are you willing to take a little bit more of a risk to bet on an up and coming city? Or do you want to look for those more blue chip type markets that you know are going to go up, but probably don't offer as much upside as some of these up and coming markets? One thing I want to call out before we get into the metrics is that over the last 10 years or so, with the exception of the pandemic, We've seen this situation where there is good markets generally have either good cash flow or good appreciation. So if you think about a good cash flowing market, it might be Buffalo or Cleveland or Detroit. And you think about good appreciation, you see Seattle or Denver or New York City. And those types of places, they don't often have both. And there are hybrids, but the reality is, if you look at this graph that I'm putting on the screen, that there is a difference. The outliers, the great appreciation markets, don't typically offer great cash flow, and the great cash flow markets don't typically offer a great appreciation. And now that has changed a lot over the last 2 years because appreciation has gone nuts everywhere. But as the housing market moderates over the next couple of years, I'm expecting that to change. And we're going to go back to this situation where markets either tend to be better appreciation markets or tend to be better cash flow markets and aren't going to have strong of both. That's just my personal opinion, but something to think about while you're picking markets. With that, let's get into these 7 metrics. And the first one I want to talk about, and the top of mind right now, is rent growth, because rent growth has been going absolutely insane over the last couple of years. And rent growth is really important to me because even though certain markets don't have great cash flow right now, if rent keeps going up, cash flow will be great into the future when I actually am planning to retire. And of course, that rent growth, if it's grown in the past, does not mean that it's going to grow into the future. And we are going to talk about some of the leading indicators for rent growth in a second. So rent growth is what I would call a lagging indicator. It's the effect of other things going on in the economy, but it is something that you ultimately want to track because rent growth is ultimately the metric of success, whether you're going to see your cash flow increase over time. So number one thing, look for rent growth. The next thing I think you should look at, which this is a lead indicator for rent growth. So this means if you look at this and it, depending on how the metrics look, it could indicate future rent growth or maybe a lack of future rent growth. And this is the rent to income ratio. And I really like this metric. It's not something a lot of people look at. It's something I really like to look at. But what it measures is what percent of a renter's income do they put towards rent. And the experts, budgeting experts say that people should allocate about 30% of their income towards rent. So if you see a market that has a rent to income ratio much, much higher than that, it's kind of a red flag for me because it means that rent can't grow. It means that renters are already stretched. They're rent burdened right now. And that means they're going to have a harder time paying their rent, and rent is not likely to grow. On the other hand, if you see a rent to income ratio that is lower than 30%, that means that renters are in a great position to pay you your rent every month. And it could mean that rent is actually going to go up in the future. So that's the second metrics. The third is income growth. At the end of the day, what renters can afford and how high rent and ultimately appreciation go is really, really dependent on income growth. And there are a lot of ways to measure this. Some people like to look at employment or unemployment, but to me, income is the number one thing that you want to track because you could see a low unemployment rate, but with jobs that don't pay very well. But if you see a market where income is steadily increasing, that to me is an excellent lead indicator that rent is going to go up in the future and property prices are going to go up into the future. So that's number 3. So far we got rent growth, that's the lag indicator. And then we have rent to income ratio and income growth as the lead indicators. The next thing I want to point out is the rent to price ratio. This is a famous metric, right? This is where the 1% rule is derived from. Basically, all you need to do to calculate this is you divide 1 month of rent by the purchase price of a property and you get a number. If it's near 1%, you're doing really, really well. But I want to point out that cash flow is pretty hard to find right now. The national average, as you can see on this chart, is 0.5%, so half of the 1% rule. So when you see a market and it doesn't necessarily have that 1% rule across the market, don't panic. In fact, I recommend to people who ask me that any market that has a 0.65, 0.7 rent to price ratio is actually worthy of consideration. And I know people are probably about to freak out and say, that's crazy, that's not high enough, but consider 2 things. One, that the national average is 0.5%. So if you find 0.7, you're doing well above the average. But two, and much more importantly, is that if the market averages 0.6 or 0.7%, that means by rule, there are deals that are both better than the average and worse than the average. So it is your job as the investor to go out and find a deal that is better than 0.6 or 0.7%. You got to go find that deal that is 0.8, 0.9, or even meets the 1% rule. So again, rent to price ratio, excellent way to screen a market for cash flow. If you just want to like take a broad look across the country and say like, I just need to narrow down 10 markets that have good cash flow potential before I dig into any of these other 6 metrics, I recommend maybe even starting with the rent to price ratio because it is such a good screening tool for cash flow if, of course, cash flow is one of your priorities. Next is appreciation. Again, appreciation is a lag indicator. It is something that is the impact of other things going on in the economy. But it is something that you really want to measure. Now, I put 2.5% average annual growth rate, and I took that back before the pandemic because frankly, the data is so skewed right now that it's not really worth trying to factor that in because I think we're going to get back to this 2 to 5% growth rate probably by the end of 2022 and into the next couple of years. Of course, things are changing really quickly right now and that could change, but that's my current read of the situation. But basically, you want to know which markets are going to appreciate. And this is notoriously hard to predict. So I have included a few more lead indicators that could tell you which markets might appreciate the most. So one of those, and my favorite personally, is population growth. This is good old supply and demand, right? If more people are moving to a market, then more people are going to want houses. That increases demand. We all know supply is super constrained right now. So seeing places where people are moving, think the Sun Belt right now, this is a really, really good sign of appreciation, both in property prices and in rent for that matter. And then the last one I wanted to talk about, again, sorry, this isn't a lead indicator for anything, but if you're thinking about cash flow, one of the things you should really pay attention to is the effective tax rate. How much are you paying in property taxes or income tax? So I think Texas is a great example. You know, Texas is booming right now. I'm looking at a few markets there. But one of the interesting things about Texas is that it doesn't have an income tax. And landlords love that, right? Because you're not paying any income tax. But, you know, the government is going to collect tax one way or another. And as a result, Texas has higher than average property taxes. So you definitely want to look at taxes and not just overlook it. Because if you take the rent to price ratio and you look at Texas as a good example, cash flow prospects super good. But the rent to price ratio is just a proxy for cash flow. It doesn't actually tell you how much you're going to be making at the end of the day. For that, you need to figure out your expenses like your effective tax rate and insurance. And so for me, insurance is really hard to look at on a macro level. So I focus more on the tax rate. So just to summarize, I'll go through these again quickly, but what I like to look at as my 7 lead indicators, and there are other ones that I look at, but these are the ones that when I am just looking at a whole state and want to figure out which markets or even which neighborhoods, this works really well for neighborhood identification too, are interesting to me. I look at rent growth. I look at the rent to price ratio or rent to income ratio, excuse me. I look at income growth. I look at the rent to price ratio, appreciation, population growth, and effective tax rate. So those are my recommendations for these 7 metrics to look at if you are considering investing in an out-of-state market. And remember, if you are considering doing this and you want to talk to an agent in any of these markets, go to biggerpockets.com/agents, where you can find a whole slew of excellent agents who are investor friendly and know how to talk and think like an investor. Thank you guys so much for joining me. If you want to download this PowerPoint, you can visit the link below. If you have any ideas for new shows or want to connect with me at all, you can do so on Instagram at The Data Deli. Thank you guys so much, and I'll see you all next week.